Okay, so mortgage interest, points, and mortgage insurance. So we've talked about some of this stuff already, so we'll see what we've got to dig into. Okay, qualified residence. So this is one of the concepts when we are talking about the IRS. We are talking about what is a qualified residence. A qualified residence would be what you can write off the interest on, okay? We're not talking about investment properties on your Schedule E. We'll talk about that at a later slide. But right now what we're talking about is what is considered your home, okay? And when the IRS refers to that in mortgage language, what do we call it? Primary residence, right? Versus second home versus investor. What is a primary residence?
Where you spend the majority of your year.
Owner occupied, okay? The IRS calls your primary residence is their qualified residence. And what is it? It's your actual residence, right? So when I say to somebody, hey buyer, what are your intentions? Are you going to live there? Are you going to be an investor? I could do any of those things. Okay, no, but what are you really going to do? Okay? So it is identified as your actual residence. So I always say, where is your bed going to be? Right? If you are sleeping there, it's your actual residence. If you are not sleeping there, it is not your actual residence. Toilet and bath facilities. So once again, that's why if you've got a vacant plot land, and let's see, something like this came up in Kahuku recently. It's got a big vacant land. You know, somebody's uncle had gone out there and built an non-permitted structure, like a little shed that they were keeping some orchids in or something like that. And the real estate agent says to me, well, that's technically a home. It's not vacant land. And I'm like, where's the permit for a house? There is no permit. We just built it out there, but they're sleeping in there. Okay? All right. Unless the city and county recognizes it as an actual permitted dwelling, it is not considered a qualified residence. That would be a couple of boards that Uncle put up, okay? Toilet and bath facilities, cooking or kitchen equipment. So now we're getting into some of the other guidelines when you've got a special property over in Gulick Avenue, right? And you've got a single family residence with 4 kitchens, okay? So this is some of the things that we need to take a look at. And then it's used by the taxpayer, meaning that they're actually living in it. And then it's elected by the taxpayer. What does that mean?
They've declared it.
They've declared it as the primary residence, both with their state and with the federal entity. And it can be a house, a condo, a mobile home, a boat. Okay, so you can elect that you live on a boat because what? Many boats have a sleeping area, a toilet facility, a cooking area, and then the taxpayer files their taxes from Ala Moana Marina. Okay, all you need is a slip number, right? And then it can actually be an address, and then it can be a house trailer for some of these. The mobile home, the house trailer. We don't have too many of those in Hawaii, but obviously we've got them nationwide. And then the second home, okay. Can you what's the difference between a second home and an investment property?
A second home you don't rent out.
A second home, technically, you can or cannot rent out, okay? But when we talk about IRS guidelines versus lending guidelines, the difference between a second home and an investment property is if you are using the income from the investment property to help you qualify. If you are purchasing a second home, you have to be able to qualify for your primary residence as well as your second home with no additional income coming off of that property. It's as if you are not renting it for income, okay? That's a lending guideline other than IRS. Now, if you are an investment property, you can use 75% of that investment property income in order to help you qualify. Who knows why we use only 75%? Why not 100?
Occupancy rate.
That's right, because of occupancy. Because everybody knows throughout the duration of the 30 years, you're going to have to swap out a renter, right? You're going to have times when there's repairs that you have to do that the renter won't be able to be there. And because of that, we use what we call a 25% vacancy factor in our mortgage guideline. Roberta, you had a question?
Yeah. Can someone have multiple second homes?
Yeah.
So we call it like a third or fourth or something. But it's the same kind of guidelines.
Well, you can have one second home in each state. So like I've got a couple of dentists that I work with, and they live in California, and they've got a second home in Hawaii. They've got a second home in Washington. They've got a second home in Florida. So you can have a second home in every state, okay? Now, when you get to Hawaii, so let me backtrack a little bit. Once again, so we're segueing into lending guidelines. When we're dealing with second homes, does anybody know the lending guideline on how far away your second home needs to be from your primary residence?
I think it's by miles, right? I don't know what it is. 100 miles?
It's 100 miles. Okay, it's 100 miles. What happens in Oahu if you go 100 miles?
Near the ocean.
That's right. You are swimming to Maui. Okay. So, but with a great story, and once again, a great loan officer, you can overcome many things. So I'll tell you a story. I had a family. He was a surfer. He worked at Queens Hospital, okay? And he lived on the North Shore with his family. It was a stay-at-home mom and a couple of kids that went to school at wherever it was, Waimea Elementary. And he wanted to buy a unit in the executive center, which is right down the road from Queens, where he would go every day. So of course, when we submitted that file, we wrote a letter. I downloaded some information about Hawaii traffic, okay, and I stuck that on top of the letter, and I sent that into the underwriter, and it got approved because it made sense that someone that works at the hospital, long hours, would want another location to live at that he was actually going to use as a second home so that he could sleep during the week and then go see his family who was already in the community over there on the North Shore. That can make sense, okay? What happens if you've got somebody in Eva Beach living on one road that wants to buy another house in Eva Beach and call that their second home? No, right? Because well, the first question that you need to answer is why. Why would you need a second home right next to your current residence, right? Something like driving down a road that takes 3 hours with construction to get to work, that can make sense. But having a secondary residence right next to your primary residence doesn't make sense, especially one that you're saying you're not going to rent, okay? So with lending guidelines, second home, cannot use the rental income, investment property, 75% of that income in order to help you qualify, right? And that's Fannie Mae guidelines. Right now, though, you guys know that there are the DSCR, the debt service coverage ratio, investor solutions, and those will be a dollar for dollar exchange on what your mortgage payment is and what the rent that you're able to fetch off that property is. And we even have programs where you can use the short-term rental, which is really cool. It's really cool to watch some of those programs morph. But back to IRS guidelines. So a qualified residence is your first home and technically your second home if you have a second home, okay? Here, we're going to see on one of the other slides, we'll cover it in a second, but right now, the qualified residence in acquisition indebtedness figure, meaning how many mortgages do you have that you can write off interest on, is $750,000. And I did check it yesterday to find out if it did rise, because I heard somebody else say $1 million, but everything that I see says it's $750,000 still. But in the mainland, where you had a $400,000 primary residence and a $300,000 secondary residence by the lake, right, or something like that, you could write off the interest on both of them. But here in Hawaii, most people, their primary residence is encumbered by the $750,000 or more already, okay? But per the IRS rules, first and second home can be used to qualify for the acquisition indebtedness and be considered qualified residences. The guideline here per the IRS, second home if you are renting it out, okay, because remember, not renting it out, not using the income is a lending guideline. IRS guidelines are going to be personal use for at least 14 days out of the year, so 2 weeks, out of the year that you've got to use that home as your vacation home, because remember, second homes are also called AKA vacation home, right? And then at least 10% of the days for which it is rented at a fair market value. So I think they've got a little right here. So if we have 200 days that you've rented it out, then you must live in the home for 20 days. So that's the IRS guideline to meet secondary residence guidelines.
Excuse me, can you repeat how much about the interest you can write off if you have a primary and a second?
$750,000. We're gonna cover it right now.
Okay.
Okay, so how many qualified homes can you have? So you can have 2 qualified homes, right? So we just talked about that. Your primary residence plus 1 vacation home, okay? But going back to that election, you must elect with the IRS and with your state entity which one you're going to be using as your primary residence. That's where that home ownership paperwork comes in, right? Which one am I going to live in as my home ownership, and which one do I want to take my tax deduction on? So you can use your first and your second home. Now, we call it acquisition indebtedness, meaning when you purchase the home, how much of a mortgage did you take? That's what acquisition indebtedness means. When you purchase the home, how much of a mortgage did you take? Okay? So, if you add up your mortgages together between your first and second home, you can write off up to $750,000. If your first home, however, like we talked about in Hawaii, is bigger than $750,000, then guess what? There's no room for your secondary residence, right? Because it's all based on a federal guideline on what acquisition indebtedness is defined as. So once again, a high-cost state like Hawaii is going to have a different type of an approach than a low-cost state where you might be able to buy 3 houses for $750,000, right? So with that being said, acquisition indebtedness guideline is $750,000 for the IRS currently. So let's take an example of what acquisition indebtedness is, because remember the definition of acquisition indebtedness is how much of a mortgage did you take when you purchased the home. So here we go. $500,000 as a purchase price. The original loan balance was $100,000, okay? So they put down $400,000, okay? And then because they paid it down, let's say for, 15 years, now they've got a $50,000 loan balance. That's why it says $50,000 later on. So then they come back and they want to do a cash out refinance. What are most people doing when they refinance their current mortgage to pull out a big chunk? What are they going to do with that?
Buy another property.
Buy another property, okay? But per acquisition indebtedness rules with the IRS, unless that new debt is being used for home improvements to buy, sell, or repair the current subject property or current residence, it's not tax deductible. So in this equation, the IRS would take the $400,000 on the new cash out refinance. They would subtract out what your current balance is when you acquired the property, and then the remainder of that would not be deemed tax deductible. Now, the IRS, up until about last year and this year, has not really been paying attention, right? So many times your CPA will just take the 1098 and plug it in your taxes. But guess what they're working on right now? And you've probably seen it all over the news. How much did they just fund the IRS? Like $8 billion. And what are they funding them for? Audits. IRS collections are basically going to turn if you thought the IRS was bad before, you just wait, okay? It's coming. And luckily for us is, from my understanding, they didn't actually train everybody. They were trying to train everybody and get them ready for 2024, but luckily they didn't do it, okay? They're running behind. So 2024 looks like it might be a semi-relaxed year, but they just got more funding, and their whole goal for this funding is to catch stuff like this. And they're
providing the
going to
budget.
start really coming down on the CPAs who are letting it slide. Go ahead.
So there's never been a time where if you took out, oh, you're talking about a total refinance, not a HELOC.
It doesn't matter whether it's a refinance or a HELOC. It's taking any equity out to not buy, sell, or repair
But
the
you could
existing
buy, you
residence.
could use the money to buy. And
To buy, nope, not in their definition. So what we all, including myself, have been advising our clients, taking out your primary residence, it's all going to be tax deductible, you'll get a better interest rate. This course is going to tell you how that all of that is not true. And believe me, I've done it myself personally a million times, right?
Because our CPA told us as long as we use the HELOC to purchase another property, that was a tax deduction.
Technically, it's not.
Well,
Yeah.
Sam Hill, that's not what we were doing.
Yeah. So technically, it's not. And that's what we're saying is up until this year, you know, it's been a little loosey-goosey, and the guidelines have not been followed. The guidelines have been this way since 2020. In fact, it was before that even, but it really took off in 2020 with the reform, and it really came forward again. But these are all of the things that they're going to start cracking down on with their $8 billion that they just funded the IRS.
As long as you don't take the deduction, you're okay. Like you just take the money out and you use it, but then you don't take a deduction. You don't have to pay the.
Well, they would do this calculation. So so just exactly as it is on the board now, if you had a $50,000 owing on the property since you bought it, and then you went and took $400,000 cash out, they would minus out whatever you had in the previous acquisition indebtedness. And then this portion would become non-deductible. And then your CPA would have to move that into a different space to say, this is deductible, we can continue to take that, but this is not tax deductible.
Is it considered income?
It's not considered income because it is borrowed debt. It's borrowed debt, so it's not considered income.
I don't have a just talking about the interest you paid on the HELOC.
I'm sorry, continue. Say it again.
I'm talking about the interest you paid on the HELOC being a deduction. No. I was hoping maybe the interest was, I was missing something.
No, we're just talking about interest. Just so you know, when this whole class is going to be just about the interest, because technically the principal is never tax deductible.
So to confirm, on a HELOC,
Yeah.
you buy another property,
Yeah.
you cannot deduct the mortgage insurance. On
Per
a HELOC.
IRS guidelines, we're not allowed to.
Interest, not insurance.
We're gonna
I asked my CPA that. You know,
Yeah.
no.
Yeah.
You can't write it off on the new property? as a
You
fixed
cannot,
deduction?
because that HELOC would have to have been taken on that new property.
Yeah, but you don't know if the
Because you
new
put it in
property
the
has
primary
another loan on it.
residence.
See, that might have only been a down payment.
Well, correct, okay, but she's just speaking directly to the HELOC itself on her primary residence, and per these guidelines, it would not be. But what Rosa is saying is, if you took a new loan in addition to that on the primary, on the secondary residence or investment property, and then that would be tax deductible because it's on that subject property, which we're going to talk about in the next slides anyway. Okay, so now, if counter, right? So if we have that same scenario, which is a $500,000 purchase price, and then same thing, you put down $400,000 at that time, you carried $100,000, and then 15 years later, you got $50,000 balance, and then you took the new cash out refinance because you were going to tear down that house and rebuild that house. Then technically, with your construction contract, that $400,000 would be tax deductible because it happened on that house. Okay, and that goes back to what you said about can you take the money from that house and use it for another one? The answer would be no, that's not tax deductible. But if you took the HELOC to repair this house, that you took the HELOC on, then it would qualify. Okay, would qualify. And you can see already in this room different CPAs, different information, but this is the guideline. So it just depends on how they've been applying it. Remember, CPAs are very much like lawyers, right? What's the loophole and how do we fit inside that loophole? But that's what the IRS is working on to train against, is how do we close the loopholes so that we can keep more money? That's really what it's about, right? I mean, obviously COVID, all the payouts, all that money they're sending abroad, right? They got to get it from somewhere. So they're going to come through the IRS. Go ahead.
So this has been in place, like this is not new law.
No.
Yeah, unfortunately.
Okay, so with the $8 billion new funds to train IRS auditors,
Yeah.
how many years can they go back?
Do you want to answer that, Rosa? It's technically 7 years.
It depends if you have a business too.
Yeah.
And if you use the property as a rental. But if you're talking about primary residence, usually 3 up to 7.
And I'm going to out her a little bit since she's outing herself, but Rosa used to work for the IRS as an auditor. No. But having an inside person in this class is super awesome, right? Because you're going to get a different perspective than you would anywhere else.
Isn't that
But
why
she's
they-
got some in-depth
I
knowledge.
can tell you right now, they don't have the worksheets for this. They've been trying to track what your balance is on that 1098, but the records are not accurate. They can't keep track of these equity loans. They're almost impossible to track. So they're going to have a hell of a time. So either they're going to just shoot a wide net and say, okay, everybody has an equity loan. It looks like they got another property. We'll audit all of you. Or they're going to say, we don't know. We'll see who the highest value is. Who can we get more money out of?
Oh, right. The ones that have more.
And they'll draw the line and then say, okay, the line in the sand is 350,000 AGI. Okay, let's go after those people.
So, like Rosa said,
Who knows
it
what
has
it
yet, it has yet to show
Okay, well,
how they're going to crack down on it. But what's going on
wants
is
to be audited.
they're funding the IRS to crack down on it, right? Which also means that CPAs will have to retake courses, right? So that they can certify that they have gone through the additional trainings and stuff like that to readdress some of the things that they have not been addressing. Okay? All right. Go ahead.
Hey, just to recap the 2 slides. So if you take out the refinance, don't use it on the house.
Yep.
Not tax deductible.
Not tax
If I
deductible.
do use it on the house, it's tax
Tax deductible.
Just-
But you're
Exactly.
supposed to use
But
it.
that doesn't mean you're not going to get audited. Because they don't know what you used it on.
Okay. So remember when I told you that this tax is like a little bit of a horror movie, and then you're gonna get some jump scare,
It's like a nightmare.
and it's gonna scare you when the ghosts come out. This is like one of the first places. Okay.
So like if you use it to consolidate debt, don't you just keep all your, you can't do that?
You can do that, but it's not tax deductible.
Your question.
Oh,
Sorry.
if you used your cash out refi to consolidate debt, does that have?
So that technically does not qualify for acquisition indebtedness
Oh, got it.
because consumer debt, like your car, okay, so the question is, did you use it to buy, sell, or repair the existing residence? Well, paying off your car loan, you did not, okay? But let's use it, your example. Let's say that I took out a HELOC, I wanted to move my mom in and I wanted to build a second story, okay? And I took out a $250,000 HELOC and I built myself a second story, and then later I came back and consolidated it. It would qualify because I used the HELOC for the home improvement
Right.
to that property. But if I use that HELOC to pay off my car and my student loan and my other
If
stuff,
you
it
do
would
it,
not.
just don't take the deduction.
Yes, exactly. Yeah, it doesn't say that you cannot take the HELOC. It just says that you're breaching IRS guidelines if you try to pass
Ability
it
to do
off
that.
as acquisition indebtedness. That's what that means.
Oh, I
To
Okay?
make the adjustments.
All right. Everybody get this? We're going to move on to more horror stories. Okay. This is just the beginning. Get ready.
Do you feel like that maybe they did that so that when you are adding more value to your house, right, your home value goes up so you pay more property taxes and you have to give it back to them anyways? because your property taxes are based off the value of your home, right?
Well, IRS has nothing to do
No,
with property
I
tax.
don't
Well,
think
I mean,
that.
I don't know if it's like a complementary
no, it's
system.
not- it's not that.
IRS
So what
and
it-
state.
What it is that what it is, because Hawaii actually has the lowest property taxes in the nation, so it wouldn't apply here locally. But what it stems from is, for those of us that have been in the industry for a million years, because I've been in almost 27 years now, okay, prior to 1996, that's why actually, if you talk to a lot of old standing loan officers, many of us got into the industry after about 1995, 1996, because that's when the lending guideline changed. And what the lending guideline used to say was that if you were pulling money out, pulling equity out, you had to use it for a property. So many of us old timers may remember that you couldn't pull out equity unless you used it for a property. Okay? What changed in 1996 was they said, it's your equity. It's your private savings account. You can use it for whatever you want.
Right.
And that's when you started getting loan officers making cold calls, right? Let's cash out your equity. Let's pay off the car loan. Didn't you want to buy something else? Let's go do that. Don't you want to just have some money in your savings account? Let's do that, right? And then that's how it started to really pick up all of this steam until we reached 2008, when everyone had pulled all of their equity out and had spent it on everything. And then on top of that, you had mortgages that were being given as signature loans, right? No income verifier, no job, no any of that stuff. All you needed was a FICO score. And because of that, they had a mortgage meltdown, right? That's what led into all of that stuff. So when folks talk about mortgage meltdown that happened in 2008, it was not just something that happened a couple years before that. It had been brewing since the guideline changed in 1996, and people started using their equity to go buy Lexuses, right? I always wanted a Mercedes. Instead of paying cash and getting a car loan, I'm going to take that loan, I'm going to pay for my Mercedes, and then now I've got a Mercedes. But you also have this elevated mortgage balance. And then if you are coupling that with high risk, no income verifiers, all of that stuff. And at that time, I was actually working in Arizona with Kat. And we were doing a loan. It was a first and second combination. It was at 85, 125. So the first mortgage was at 85%, and then the second mortgage took you over your home value to $125,000. And now you could buy whatever you wanted, right? And people loved that loan. It was flying off the shelves. You actually needed to qualify for that loan, okay? But that's the type of lending that was out there. Now, full circle, mortgage meltdown happened, and the pendulum swang the other way, right? And for a few years, nobody could get a loan. It was just crazy, right? But we didn't have the culmination of issues that we had this time around, which is, you've got the super tight credit lending situation, coupled with home prices still going up, coupled with interest rates going up. At least during mortgage meltdown, people's homes were going into foreclosure, but interest rates were still 4%. And then if you could qualify, you could actually pick up a bunch of property, right? We have a lot of clients that picked up a lot of short sales, a lot of foreclosures. They've got huge portfolios now because they were able to leverage the market when it took place, which is kind of what we see now, right? Whose playing field is it right now? Investors, right? If you got the cash, you can play, right? So that is really what happened with mortgage meltdown, okay? And then now we do have some loosey-goosey programs. We've got the debt service coverage ratio. We've got stated income. I think we've even got a flyer in there for you because PRG has one of the only fast and easy programs. But the reality of it is the difference is that no one is performing those transactions on a 550 FICO score to 100% loan to value with no job, Okay, that was the difference prior to mortgage meltdown, was that you had really low credit scores, no qualifying credentials, and then on top of that, they were taking on these high loan to values, 100%, 95%, whatever the case may be. So you had a bunch of folks with no credit, no jobs, no skin in the game, which led to a lot of foreclosures, right? Why is it? So the guideline now, what is the guideline for you not to have, when you're purchasing a home, what is the lending guideline for you not to have mortgage insurance? How much do you have to put down?
20. I thought 20.
It's 20%, okay? 25 is a magical number in lending terms many times when you're speaking to your loan officer, because that's where the rate bump happens, okay? There's a loan level pricing adjustment that happens when you go from 75% to 80% loan to value. So if you're putting down, as an investor, if you're putting down 25%, you're always gonna get a little bit better interest rate than if you put down 20, okay? But for the average bear, all right, 20% down is the magical number for you not to have mortgage insurance. What does mortgage insurance do?
It covers in case there is a foreclosure.
It covers the lender.
Mortgage company to resell.
Yes, both of those are right. What it does is it does not protect the buyer, it protects the lender from default, okay? And what that means is it does not pay their mortgage payments forward or any of that stuff. It pays for the foreclosure proceedings, for the court time, the attorney time, for every letter that they've got to send out that says notice of default, make your mortgage payment, notice of default, make your mortgage payment, and then that sheriff that they've got to send out to get them out of the house when it's time, right? That's what the mortgage insurance does. It's an insurance policy for the lender to pay for the court expenses and attorney expenses should they have to go to foreclosure and take that home back. Okay. So 20% is the magical number, because what they found out was when that home goes into foreclosure, between allowing the homeowner to stay there for many years, okay? Because the other thing that happened after mortgage meltdown was there was a lot of legislation that came down to protect homeowners from foreclosure. And we saw some of that get implemented just recently with COVID when they said, forbearance, nobody has to make their mortgage payment ever again, right? Yeah. Which some people understood as, oh, I get a little break from my mortgage payment, I'm gonna have to pay it back eventually. And some people took that as, well, you said I never had to pay it, why would I give you any money at all, right? So interpretation, okay, is an issue when you play with those guidelines. But what they found is, in order for, if the loan goes into default, within the first 90 days, you get the letter that is called a notice of default. Hey, you haven't made your mortgage payment, make your mortgage payment, you're headed towards foreclosure. 6 months, you get the notice of foreclosure that says, hey man, you haven't made your payment in 6 months, we're gonna foreclose. And then depending upon what happens with that homeowner and whether or not they file hardship and do what they're supposed to do, because right now there's a lot of legislation, right? All you gotta do is call your lender and say, hey, I've had a hardship, I lost my job, my husband passed away, my mom, something, whatever the case may be. As long as you've got a legitimate hardship story with supporting documentation, they will work with you. They are required by law to work with you. I actually had a client call me. I had helped the husband and daughter or wife purchase a home, and they called me about 6 months later and they said, hey, we need you to help our grandma. And I said, okay, great, I'll be happy to. Where does grandma live? Grandma lives in Waianae, and her home was going into foreclosure. And it's all because my dad grandpa had passed away. And I said, well, when did grandpa pass away? 7 years ago, grandpa passed away. I said, well, how many payments has your grandma made since he passed away? 0.
Oh, wow.
Yeah. So 7 years, and now, 7 years later, they're actually foreclosing on her, and she had to go to court and reinstate the property and do all this other stuff in order to try to keep it. But that is what the legislation has done, right? As long as you are talking to the lender, as long as you're telling them what the hardship is, as long as you're filling out the paperwork, it makes them very difficult for them to foreclose on you, which is why, even though we have a lot of loosey-goosey loan programs now, are they for owner-occupied? No, they're all for investor, because the legislation applies to owner-occupied people that are making the homes their qualified residents as opposed to investors. And we saw the exact same thing with COVID. Who got their forbearance? The owner-occupied people or the investors? Owner-occupied people. How many of you in this room have investors in your portfolio that some of them were stoked, right? Because they had renters that were still paying rent and they were fine, and then we had other portfolios where their renter decided to take the forbearance and the rent moratorium and was not paying their rent, but the investor still had to pay his mortgage because it didn't meet the guideline. So we also have a lot of investors that some of them were just fine during COVID and some of them lost their pants during COVID. All you needed was a couple of bad units with folks not paying, right? And then their gripe was, well, that's not fair. Why would this apply only to owner-occupied but not to my investment properties when you told my renters not to pay their rent? Thus in the problem, right? So was it fair? No. Does it make any difference at this point? Not really, right? Because it is what it is and now it's over. But the reality of it is that was a real case that just happened, okay? With COVID. All right, back to acquisition indebtedness. Okay, we got this in your file as well. So this is, when is mortgage interest tax deductible? So, number one.
It's easier to read.
It is. Put your glasses on. Just kidding.
Oh my God.
Okay. Do you itemize your tax deductions? So you cannot take mortgage interest deduction if you're taking the standard deduction. So we already talked about that, right? You're either going to itemize or you're going to take the one lump sum. In 2020, the standard deduction is $1,214. We can skip all that because we actually went over that. Ask your CPA for details. That's the main gist on number one. Number two, what is your qualified residence? It can be, you can have two. You can have your primary residence and you can have one vacation home, but it's got to be less than $750,000. Got it. Okay. Number three, is your mortgage classified as acquisition indebtedness? And then these are some examples here, but we already went over it, which is if you use the monies that you pulled out of the subject property to buy, sell, or repair the subject property, then it is considered acquisition indebtedness and it does qualify. If you took the money from here to spend it over there, it's technically not going to meet it, but like Rosa said, it's up to the IRS to develop the worksheets and to push it back on the CPAs. But they have funded that already, so let's see where that all turns out. But this is just another example of what we just went over, okay? All right, let's move on. So, here, is it smart to pull cash out of a primary residence to purchase a vacation home? Up until this class, we were all like, hell yeah, right? Okay, so technically, if we pull cash out of our primary, we did not use it to buy, build, or improve our current home so that it bounces back. It's not considered acquisition indebtedness. Technically, it's not allowed for the write-off. So if we buy the new home with a new mortgage, because it's on that subject property, then it would fit into that acquisition indebtedness situation, okay? And that would apply, so let's say that we're lucky enough to live in Hawaii with a $400,000 loan balance because we've been in our home for quite a while, and then we go buy something in, Charlotte, South Carolina, and that is $350,000, then we could write off both of them underneath this federal guideline. Okay, that's how that works.
Wait, repeat that?
If you have, so let's say you live in Hawaii and you have a low mortgage balance, like $400,000, and then you go to the mainland or even one of the other islands, and you bought a condo or a house for $350,000 as a vacation home, then now they both can be qualified indebtedness underneath the $750,000 federal guideline.
Okay, so you're saying not the original loan amount, but the balance you have left on your loan, on your primary residence. Is that right?
So, technically, it would be your original loan balance because it's what you originally borrowed.
So just to clarify then, you can't have mortgages for more than $750,000, or you can't claim the interest deduction on mortgages of more than.
Yes. So for folks in Hawaii that just took a new $1 million home loan, which everybody did, right, over the last year, every new purchaser pretty much took $1 million loan balance. They can write off $750, and the other $250 is not tax deductible. Because by the IRS, they're considered too wealthy for that.
Oh, that's on their primary residence?
That would be on their primary residence. Because you can have up to 2 residences, up to $750.
What if you own a joint with somebody else? The loan, it's joint, 2 different owners, joint.
Well, then it would play exactly the way that you guys file your taxes now. Okay? So let's say you had it with your husband and you guys were filing jointly, you would still be this.
Right.
Let's say you had it with your sister and she was filing half and you were filing half, then in the same way that you're doing it now, you would have to apply underneath these rules.
So I would say, so we buy $1 million house together and we have $1 million loan, and then we're own it equally half and half. She would declare $500, I would declare $500.
Yes, exactly. Which is what you would do regardless of this guideline with your CPA, right? When you went to speak with them, you would say, hey, me and my sister bought this house together. It's $1 million loan. We want to split the interest in half. And then that's what he would do, right? Is put that little cover letter on it that says this one is linked to this one and these guys are splitting this. Because the IRS, when they take a look at that 1098, the first thing they're going to say is, well, why is this $1 million but you only write off 500, right? And that's where the little notes come in that you're sharing it with somebody else. And that happens a lot when you're partnering with somebody on it, or when a parent put in a bunch of money to help the kid, right? A lot of times they'll be like, I'll help you buy this house, but I'm taking the tax deduction because you don't need it. You're only making $20 grand a year. I need it because I had to give you all that down payment and qualify for the loan, So that will happen a lot of times. Okay, so the next question. Is it smart to pay cash for a house? Okay. So if we have a cash purchase, technically there is no acquisition indebtedness because you never took out a loan. Okay. So what we want to talk about is if we do a cash purchase, there is a strategy called, I think it's the next one, delayed financing. Okay. The strategy is called delayed financing, and what that means is that if you have a customers that want to use cash to buy a home because the home needs renovations and can't qualify for a traditional mortgage, they want to lowball the hell out of the seller, right, and give them that cash offer. I can close quick, don't even talk to the guy with the loan. So if you have a buyer that loves to pay cash, one of the strategies that you can use for them is delayed financing. And what that means is that they purchase the home in cash, and within 90 days, they put a mortgage on it, okay? If that's the space that they're in, then it is called the delayed financing exception. A number of things will happen. Number one, the lender will treat it as a purchase money loan, meaning that they'll get purchase interest rates, because we all know that purchase interest rates are better than refinance interest rates, okay? So they'll get the better interest rates, they'll get the better terms as if they had just purchased it within the 90 days. That's called delayed financing. That way, for you guys as agents, that allows your investor to stay in the game, right? He buys his property, he acquires it, you help him make it whole, make himself whole, he gets all the money back or a portion of it back. When he puts the delayed financing mortgage on it, then he can take that chunk of change and keep on investing. Okay, so the delayed financing exception and strategy is very powerful for your cash buyers. The IRS, of course, recognizes that as well, and they give you a 90-day term. What I can tell you is that before you even embark on this strategy, you want to make sure that your buyer is pre-approved. Nothing's worse than promising him, don't worry, buy it in cash, we'll work with the lender afterwards to get your cash back out, and then you find out after that he doesn't even qualify, okay? That's a bad investor, okay? So you want to make sure before they embark on this strategy that just like if they were going to take a traditional purchase, that you get them pre-approved, you get all their documents in, you make sure they're eligible for financing, and then we can talk to them about the delayed financing strategy and pulling their cash back out once they purchase the home. In order to show this to the IRS, they're going to require your settlement statement. They're to show when you close and how much you paid. They're also going to require your closing statement on your mortgage, right? To show when you closed and to make sure it's meeting within those 90 days. And then on top of that, they will require all of the other items, which is showing that you are a citizen and all this other stuff that it shows in here. But the premise is that get them pre-approved to make sure they're eligible for the delayed financing after the fact, and then make sure that they're retaining their documentation to give to the IRS to show when they closed on the property with cash, when they took the mortgage, and that they're meeting that 90 days. Okay, and that is the delayed financing strategy.